It's Christmas season, and so therefore it means it's time to talk about taxes.
Oh.
I know, for some reason, it is how it is.
No,
but
I
because
guess year-end.
we're getting to the year-end type of stuff, and if you are a strong W-2 earner, that means you got yourself a tax bill coming at the end of this year. And if you're not passively investing, it means that you're probably paying more than you should be. And so this is for you. We're talking about passive tax benefits.
Hey.
It's going to be awesome on the Furlo Capital Real Estate Podcast, where we dive into the intricacies of passive real estate investing. And our mission is to equip people to invest wisely and keep as much of it as they can so that together we can build wealth while improving housing. I'm James, and this is my wife, Jessie.
Taxes. You said taxes and benefits in the same sentence, and I was like, those don't typically go together. That was like initially what popped into my head.
That's why you pay taxes.
Like,
you get benefits.
Yes.
Of learning to have an open hand.
Learning to have
with
an
the things that you
open hand.
have, and recognizing
To
that
be
it's
generous
not, that nothing is
with your
actually
hard-earned
yours.
money.
You're just a steward of things.
I guess that is all true.
It is all
And
true.
if taxes are being used well, then
Well, that was a big if.
that is,
Parts of it are.
People are willing to give them. I've seen there are booths popping up everywhere, and like even at that market we went to,
Yeah.
they had the
That
sign
Christmas
the thing,
bazaar.
sign the petition to not tax something.
Gas tax. Because Oregon
Okay,
is increasing
apparently is
gas
increasing
tax a lot.
gas tax,
Yeah.
food tax,
Yeah, man, that's the
whatever.
thing.
We don't have food tax, so why don't we just start taxing food?
Oh,
No,
you do not wanna head down that
don't
rabbit hole.
say it.
Trust me, man. No, but if you are a W-2 earner, like think doctors, executives, tech professionals, like what I used
Sure.
to be, man, you get hit with taxes the highest because they love to go after those high income earners, even though you may be thinking that you're playing it safe.
Sure.
And honestly, there's just issues with the stock market that I have where you can't depreciate shares, for example. That's
Yeah.
not a thing. And just traditional portfolios, they can create these phantom tax events as well that happen. And so there's an opportunity out there. There's an opportunity to protect your money with different write-offs, and a lot of them have to do with physical assets, specifically real estate. So we're going to talk about ways that you can legally shield your income
That's pretty awesome.
with real estate. It is going to be awesome.
Yeah.
And so I already hinted at the first one because it's the big one. I think my guess is you know what it is. It's the big D word.
Yeah, depreciation.
Yeah, yeah.
Which, I don't know. I never really understood. So maybe you can help me to figure it
sure.
out.
Okay. Yeah, depreciation is interesting.
I mean, it's like, okay, I should just let you define
Take a
it.
guess.
'cause
No, I want to
probably-
hear. No, I want to hear your guess.
I
It's gonna be
always
awesome.
kind of thought about it like as something gets older,
Uh-huh.
like it gets more worn out,
Uh-huh.
and so it's not worth as much.
Yeah, think of it more like a manufacturing machine.
Okay.
Don't think real estate. Think more, you bought a tractor to help you dig ditches.
Sure. And it gets older over time and therefore less effective.
Correct.
Oh, see, that makes so much more sense. Like for a tractor.
Yeah.
For a house, it's like, yeah, but
Which
I mean,
is
you're
kind
gonna
of true for the
fix it,
house
I
itself.
guess.
So this is interesting. So for depreciation, they actually make you do a split between how much of it is land versus how much is the actual building.
Okay.
And so you depreciate the building, not the land.
Which makes sense to me because it's like the land is the land. Like it's not going to disappear
Doesn't get any worse
or get
in theory.
worse, I guess.
Correct.
Unless there's an earthquake or something.
Yeah,
So,
no, that's yeah. Which even then, if you're on the coast, it's maybe.
yeah.
But yeah, no, so it's about the structure itself. And it's that exact same idea. These things get old and worn out over time. Now, it just so happens that the value of land and the use of those things, they tend to just keep going up over time. Even if the place is getting used and old, because you tend to maintain and repair it anyways.
Right.
But it is this, so just like the government wants to incentivize you to invest in stuff like tractors and machinery and things like that. And so that's why they say, yeah, we know you're going to spend a lot of money up front, but then you can kind of recapture that as so typically, let's say you buy a new computer, okay, for your business.
Yeah.
The government goes, awesome, cool, you can write off that entire expense year one. Cool. But if you get, let's say, a car, they're like, whoa, we're not going to let you write off that entire thing on year one.
Just because it's too
because
much
we
of a hit.
know it's going to last longer than that.
Oh.
And so
well,
they
computer's
make
going
you
to last longer than that too.
I know,
How do
but
they make the lines?
Oh, there's rules on what's the type of asset that it is. So like cars, I believe, are like 5 years.
Interesting.
Same with like appliances. Carpets are like 10 years.
Yeah.
Like there's a whole
property is like 27 or
27 and a half. Unless it's commercial, then it's 39.
So random.
I'm just saying, like
they
that's
just take averages.
So it's actually in some ways it's worse than what you would normally get to do for a business expense, right? So like all my subscriptions, I write those off year one.
Right.
There's no depreciation. So it's kind of fun when people are like, it's a depreciation benefit. I'm like, yeah, but it's not as good as other short-term ones. But so that's
interesting.
But the idea is it's this cost
Yeah.
that you get to take over time. And as you know, often with real estate, you don't just plunk down cash for the entire thing.
Right.
You're getting loans and whatever. So let's say, let's see, let me think here. If you buy a place for, let's just say $270,000 for the fun of it, and you do $70,000 down, get a loan for the other $200,000, every single year, you're going to get to write off, quick math, $10,000. And
why?
Because you get to depreciate $10,000 because 270,000 divided by 27 is 10,000.
Oh, that's why you did that math.
Yeah. So you go to do your taxes, and it's like every year you go, oh yeah, and I have this additional $10,000 expense that didn't come out of your pocket necessarily because you've already paid for it. And you got a
so
loan
they just take
thing.
the total and divide it by 27 and a half.
Well, okay. Well, let's say you actually paid 350,000 of it, but some of it was land, and the building itself was worth 270. But yes.
Okay.
Yeah. They take whatever the building value is, divide it by 27 and a half, and that becomes an expense, which I'm putting in air quotes that you can't see if you're listening to, because it's not an expense that you feel from your
that you're
pocket.
actually paying out of pocket. Yeah.
Correct. Because in theory, you've quote already paid for it.
Yeah.
In year zero.
They're just spreading it out a little bit.
Yes.
That makes sense.
Yeah. And so
another way you could say that is depreciation is spreading out the tax write-off over a longer period of time.
Yeah, 100%.
Okay.
Yeah.
I understand that more now.
There you go.
There you go.
Welcome. Now, if you ever sell the asset,
you done, like you don't get to.
Well, that's where actually what the government goes. If you sell it for more than it was worth, they go, oh, it didn't actually lose value, did it? I guess you can pay us back for that.
Oh.
Yeah. Pay us those back taxes, please.
So you got to watch when you sell and how you sell.
Pay attention. That's why the 1031 exists, so you can roll it into another property.
Makes
or they give you an exception if it's your primary home. Depending on how many people you are, there's a certain amount where they go, yeah, don't worry about it.
Oh.
Yeah. Well, it's yeah. There's another thing called bonus depreciation and cost segregation.
Okay,
which are essentially accelerators of depreciation. So there's a new rule where, let's start with the cost seg first. It'll be easier to explain bonus depreciation. So in a cost segregation, in theory, you pay someone, and we can be up in the air on whether or not it's actually worth paying someone. But essentially, they go, look, you can do your entire property for 27 and a half years, but we know that the value of the property is not all that. You do have some appliances, and you do have some rugs, and you do have some windows, and you do have a bunch of these other things that are all less than 27 and a half years. And so they say, well, okay, instead of your appliance essentially being written off for 27 and a half years, let's do it over 5. And so you get more faster.
But when they're doing like the property value, that doesn't include all of the appliances.
Yeah, it does in theory.
Stuff.
It does.
Really?
Yeah.
Because certain appliances
think about
stay
when we
with
bought
the
our
property.
house. Yeah, like it came with all the appliances. That was part of the
that's
purchase.
True. Like refrigerator and stove and furnace and
not necessarily the furniture, but
yeah,
anything that's what's the word? Appurtenance, whatever.
Yeah, it's like
real property, whatever.
In place.
Yeah, fixtures. Yeah. Yeah. So essentially, you might change your average instead of it being 27 and a half, and actually might move it down to like say 15 years.
Okay.
Now, certain parts like the roof, you're stuck with 27 and a half.
Sure.
But
because they last a long time.
Yeah. And that's whatever that number is.
Huh. And they just average it all together.
Yeah. Well, you have to have someone go through and do all the math to figure out what all the parts are.
Sure.
And then they go, okay, you've got, let's stick with that 270 value. They might go, well, you have, I don't know, 50,000 of it's the 5-year stuff. You have another 100,000 that's the 10-year stuff, and the rest of it's the 2,700.
Interesting.
Then you have a little report, and
adds it all up.
You got to do it right. Hopefully it adds up to $2,700 to $270,000.
Yep.
And then you go, cool. And then your tax accountant says instead of just being one liner, it's like however many lines. It's 5 or 6 lines.
Yeah.
For all of it.
I mean, it reminds me of like we've had spaces in our home that we've used as like a business space.
Yeah.
And so you get to write off some of those expenses, but you have to, it's like a percentage because it's like you're not using your entire house as a business. You're using like this many square feet. And so that's the percentage that counts as
it's a similar-ish idea.
Yeah.
It's more of the 27 is they're using whatever the longest time is for the entire thing, and it's just not true. But you got to be able to prove that it's not true.
Right.
And so, which oftentimes you have to pay someone cash to do it to save on taxes, and I'm always dubious on whether or not it's worth it. But the idea is, it lets you speed up that depreciation, those phantom costs. And depending on the investment and how long you're holding it for, like if you're only holding an investment for 3 to 5 years, like you could essentially pay 0 taxes on your income for those 5 years. Now, if you're going to hold on to it longer, it may not be worth it. But now, bonus depreciation builds on top of that. So there's a new rule that says for anything that's, for any of those categories that are, I'm going to mess this up. I think it's like less than 10 years. It might be less than 15. They go, you can do it all in year 1.
Oh.
No need to wait.
So you do kind of get a bump.
You get a bonus.
Year 1.
Yeah.
Bonus.
Year 1. Right. And the cool part about depreciation is if you don't use it all, it just rolls into the next year. And so it's okay if it's like, man, that first year was a massive number. I really did pay 0 taxes.
Yeah.
But now I got a negative tax bill. And they go, we'll just keep it going until you finally catch up.
Interesting.
Yeah.
That's kind of cool.
It is kind of cool. So that's cost segregation and then bonus depreciation, which are both kind of subcategories of depreciation.
So if you're doing a syndication, your sponsor is navigating all of those numbers and trying to get you the best
your sponsor's tax account, but
benefits and things.
Yeah. And it costs a lot to hire someone to walk through and do all that math. So they tend to only do it for larger projects.
That makes sense.
Though technology is making it easier and easier to do it. And so it's starting to make sense for smaller and smaller projects. Like in theory now, I can't remember the name of the company, but they just have an app that you can use. You take pictures and document everything, and they're able to estimate it from there.
That's cool.
And so like you can do it for, I think it's like $100.
Wow.
It's great. Like normally these things are thousands of dollars.
Yeah.
And so, there you could do it for homes
reasonable.
and stuff. Yeah. Okay. It's not as accurate, but you're also like, the risk isn't as much because it's a smaller asset.
Yeah.
In theory, I could do it for Baker Tower, but I got a quote on it and it was not cheap. And it was like $20,000.
Oh my word.
And I was like, okay. I mean, it's not a small building, but
right. Huh.
Yeah. So you pay $20,000 up front to then save on your taxes.
Sure.
It's weird math. And it's not it's not save on your taxes. It's to not pay them right away. To not pay them as quickly.
Yeah, it's just spreading out the cost over a longer time period.
Yeah, because you got to remember, like, if you do the bonus depreciation and a cost segregation, come year 15, dude, your tax bill is big because you've used up all the depreciation. So I'm kind of like, I don't know, is it worth it? But there's the whole time value of money argument.
Sure.
And so I guess if you are perfectly good at timing and using your money, awesome, cool. Or again, if you have like a 3 to 5 year investment, then it makes sense because you're never going to hit that longer term.
Yeah,
time
you
frame,
won't run out
so
of depreciation.
Yeah. That's the trick. Don't run out. So the longer you hold on to your property, the less those things are valuable.
There you go.
Well, I mean, bonuses. Yeah, anyways. And the bonus, again, it's not for the entire thing. It's just for those shorter ones.
A portion of it.
So you kind of got to pay for the cost seg to take advantage of the bonus depreciation. But you get regular depreciation no matter what. That's free-ish. You just gotta, it's whatever. It's part of the deal. All right. That was the first 2. Dang. All right, awesome. The next one, number 3, is phantom losses. You have things like mortgage interest, which you're going to pay no matter what. And then you get to essentially write those off and go, no, that's a general expense, which it is, but it just never feels that way.
Right. Just kind of like it's baked in, but.
Yeah. And then we already kind of talked about this. If you do capital repairs, it's kind of that same thing. You can carry those things forward. And then you have those carry forwards for when, if you have more than that, which is just they can help boost your returns for it. The next one is the 1031 alternatives for passive investors. So this is really interesting, and I've been trying to learn more about it. So again, we've talked about the idea of a 1031 is if you have a bunch of depreciation and capital gains, if you sold it just straight up, you would all of a sudden have a massive tax bill. And you'd be like, oh my gosh. Well, instead, through the 1031 exchange, essentially they say if you have a like for like type of whatever, you can then essentially roll over all of that capital gains and depreciation onto the new property.
Yeah.
So instead of starting out with zero balance, it's whatever that old balance was, which is great. And then it can snowball. And if you ultimately end up selling that final property, oh man, like it's a massive tax bill.
Right.
But who cares? Because you got to build essentially tax-free wealth.
Sure.
Right? Because if you had to pay, you could buy just a smaller property each time. But this lets you buy bigger projects every single time. So super cool. But there does come a point in time where investors you want to get out of the race, because then what they say is, well, you keep 1031ing it, and you get onto it, and then eventually you die. Your heirs, they get to reset that basis. Essentially, it goes back to zero. So they could sell it, there was no depreciation or capital gains. Dang, that's huge.
How does that work?
So the depreciation and capital gains goes with the person, not the property.
Oh.
Yeah, so if the person goes away, the people who inherit it, it's as if you sold it to them.
Interesting. So they just now it resets at the current value of the property, and they could sell it for that.
Yeah. This is one of the reasons why on my side of the family, they have not sold my grandmother's house and cabin.
Because it kind of makes sense.
Because they've owned it for 50 years.
Yep.
So it's been fully depreciated, and it's worth, because it's in the Bay Area, 6 figures. And it's and she hasn't lived there for a while, so you wouldn't get to write off that first amount anyways.
Sure.
But if they wait, which is why they're renting it out right now, so if they wait, then it essentially resets to zero, and they can sell the house tax-free, move on.
Wow.
And then the other crazy part is some people want to inherit the cabin. Super sweet cabin, awesome. I went there all the time growing up. But again, if they just gave it to them now,
they'd have all
that would count as a sale.
Yep.
And someone,
they'd have to pay capital
grandmother
gains.
would have to pay the capital gains and all the depreciation, all that stuff, which would be interesting because they actually built it on land. I don't know how that works, but whatever. 100% essentially of those gains would be the sale would be taxed. And I guess whatever minus the land is, not important. So they got this other quandary. We're like, great, now what do we do with this one? To which I was like, yeah, you just lease option it. Lease it to those guys. They can run it. They own it. They're in charge of maintenance, all that stuff.
Yeah.
Then they have the option for when she finally passes, they can buy it. So they can have control today without doing it. So it's very powerful, but not everybody wants to do that. Not everyone's like, yeah, I want to hold on to these assets forever. So I've been learning about this. There are very creative, very smart people who have been trying to figure out how to, I'm going to say, get around this. Okay. So there's something that's called a Delaware Statutory Trust.
Of course there is.
Of course there is. Of course there
Whatever
is.
that is.
So here's the deal. When you do a 1031, it's really interesting. You have to have an intermediary person. The second I touch the cash, a tax event happens. But as long as I never touch it, we're good. So in theory, what happens is when I sell my place, I don't get the money. It goes to this third party 1031 exchange escrow person, essentially. And then they put in the funds to the next property. So I never touched it, which is kind of actually really interesting, some subtleties there. If, let's say, I wanted to take out like $20,000 just for myself, I could say yeah, give them all of it, but give me $20,000. I'll pay the taxes on that $20K, and then the rest of it rolls over tax-free. You do partials and all sorts of stuff.
Interesting. Sure.
It is
but the instant that you get it, you pay taxes.
I pay taxes on it.
Yeah.
So Delaware was like, I got an idea. They kind of capitalized on this idea of and it has to be like for like is kind of the thought. But they go, well, what if we put it in a perpetual escrow account? And then we just pay you interest on that escrow account. So you're always trying to it's kind of it's weird. And so, and I'm people who are technically into this, and I'm like, you're not representing it right. I know. I'm just trying to help my wife wrap her head around how this works.
I'm not going to get it if you tell me the right way.
Let's say I sell a property and I put it into this statutory trust account. Have I touched the money?
No.
So I'm not having to pay taxes on it. Yay. And then they, under my direction, invest it somewhere else, say the stock market. and it goes into a regular index fund. That earns interest. They charge a fee to manage it for me. And then whenever I want, I can withdraw funds from that account. I then pay taxes. It becomes almost like a normal retirement account.
Yeah, it's not a 1031 because they're not putting it back into real estate.
Correct.
They're putting it into this holding account. Like a retirement account.
Yeah. That's a good way to think about it. Yeah. It's kind of an interesting loophole of you, quote, getting out of the game without having a pile of cash that you have to worry about.
Yeah.
Now, again,
that makes sense.
Whenever you get the funds, you got to pay for it, just like a traditional retirement account.
But that's only in Delaware?
They're the ones who put together the statutory trust.
Oh, they created the concept.
Yeah. I mean, you can live
thing.
wherever, but the money's held in one of those accounts there. I mean, they might have them in other places.
I could see that being really valuable for someone who had invested in like buy and holds over long periods, and then eventually they're like, we can't hold it anymore, and we don't want to pay the big capital gains tax.
Yeah,
just getting rid of it, so we're gonna put it over here.
Yeah,
but we don't have all the management and property maintenance and all of that sort of stuff.
Yep.
Yeah.
It's super cool. Huh. It's especially cool for passive investors because you may not have control over when that project is sold. So I can think like Baker Tower, right? I want to hold on to this thing for 10, 15 years, but eventually it'll make sense to sell it. And maybe you're like, well, I don't want to. I'm going to have a big tax bill that comes for it. You can instead roll it into this thing and you're good.
And then
I think. Talk to your tax advisor about that. I should make that caveat. I am not a tax professional. This is informational purposes only. Please talk to your pro before. I should have said that up front. In case it's not obvious, I'm really not a professional.
So if,
on taxes,
like in that particular case, if you rolled your money into this statutory account thing,
a DST, Daylight Savings Time, Delaware Statutory Trust.
If you rolled it into the DST, to kind of not pay the capital gains while you're waiting to reinvest it, can you pull it back out of that to reinvest it in an
interesting question?
Property?
I don't know. Probably not, but maybe. But I don't know.
Depends.
It's not. It's more end game,
right?
Is what that's
as opposed to hold that thought, and then I'm back in.
Yeah. If you're still gonna 1031, like go through the normal way of doing it.
Yeah,
because there's a whole bunch of extra fees and everything doing it that way, and it's. Yeah.
I was just thinking as a passive investor, if you weren't ready to sell yet and you don't want your big chunk of cash, it's like, okay, I'll put it in here, but I want it.
That's a great question.
Later.
I actually don't know the answer to that.
Yeah.
That's a good question to ask a DST expert. Yeah.
Interesting.
Okay, this next one is probably one of my favorites because it's super cool that you can do with a passive investor that you can't do you just can't do it other ways. So it's refinance. That's it. It's amazing. It's a totally cool tax-free way of getting money. So let's say you've got a property, you bought it for $100,000, you have a loan on it that was, I don't know, $100,000. You have zero, whatever in it. Over time, the property value goes up. You have a choice. You can either A, sell the property for $200,000 or B, refinance it for $170,000. You would refinance it all day long because if you sold it, not only would you have transaction fees, but you would have the capital gains and depreciation taxes that you would have to pay on it. You would actually get significantly less than that $170,000 when it was all said and done. So instead, what you do is you take the mortgage that you have to pay. It's a thing, but you get the cash tax-free up front, and usually you go put that to work and do something else.
Sure.
Like this is 100% what wealthy people do. They don't sell their assets. They just refinance them over and over and over again. And then what they do is, this is amazing, is they then take that money, reinvest it, and then live off the cash flow off of whatever that new investment is, and that that investment pays for the mortgage. Or I don't want to say it. So you have this property, $100,000. You've been living off the cash flow off of it. Cool, right? And then what you do is you get this new loan on it. And so you can no longer live off that cash flow, but you can now take that $70,000, or I guess $170,000 really, and you can now roll that into a bigger project where your cash flow is now more.
Yeah.
And so on this on the first one, like now the cash flow is just paying for the mortgage. It's no longer paying for your lifestyle, but it's paying for itself.
Yeah.
And then this new one is now the one that you've stepped up and is now paying for your lifestyle. And what makes this really cool is like 5-10 years from now, you do it again for both of them. And you just keep ratcheting that bad boy up, because by then, like, 10 years in, that first one, you're like, oh, actually I'm getting additional cash flow because every year rents go up, your mortgage stays the same, and you just keep on trucking. It's 100%. So especially like when you see these guys out there, like they're buying boats and whatever, like they're doing it because
refinance,
it's all
and then
pre-tax money because it was all from debt. And yeah, they just got a property that's paying for the loan on it. It's kind of insane. It
is kind of brilliant.
It's really kind of sweet.
I mean,
yeah, you're in debt and you're leveraged.
You're leveraged, so, and your debt increases, but
so it's important to have good assets. Have it backed by good assets.
Sure.
Yeah, and you obviously don't want to over leverage yourself.
Yeah.
I use an extreme example to make the math simple.
Sure.
But
but there's a balance there.
Yeah. So I think the combination of doing that 1031 into bigger projects and then doing the refinance, like,
yeah, it's like if you're doing the refinance and reinvesting, that's the good combo, because you are leveraged. However, you're also reinvesting to increase cash flow and assets and all of that. It evens out. If you're just refinancing, like you said,
well, in theory, what some people do,
go on vacation or
something. So let's say that you're doing flips, right? And that's your primary. You've got that job going on. In theory, what some of them will do is they'll then, after they do a bunch of flips, they'll then go buy an asset, and then maybe they keep doing the flips on the side, but then eventually they refinance that asset. And again, you get a mortgage where you're more than the cash flow from the assets paying for the mortgage. And so you get a lump sum of cash.
Yeah.
And then they go, yeah, this is my fund money.
That makes sense.
Because my assets paid for it,
sure.
Whatever. And that's just, so they'll even do that kind of thing. I mean, in that math, like, it can kind of make sense.
Yeah.
Where you can imagine if we took Sarah Line Apartments, we got a pretty small loan on it relative to its value. Like, we do live off part of the cash flow, but I could see us very easily, like, we don't 100% live off of it. And so I could see us saying, well, what was that amount? Like, let's figure that out. And then we're still gonna have a chunk of change left over. It's like, yeah, man, let's go on vacation or whatever. Like, I could totally see the logic behind it, but it's cool. Let's see. We already talked about the legacy thing of the step up basis, where if you hold on to it long enough, then your heirs get it, which is a tax benefit for them, not necessarily for you, but whatever.
You're thinking of your family and planning ahead for them, so that makes sense.
That's nice, I guess. That is a benefit.
Come on, you said at the beginning nothing was yours, and you're just stewarding it. So
yeah, fair enough.
Well, for those after you.
Fair enough. And then we already talked about the loss carry forwards as well, which is a cool just safety net, which is neat. So I think a lot of times when people first get started, and I think this is rightly so, they just look at cash on cash. Like, how much money am I getting for the money I'm putting into it? Like, that's it. And they, for the most part, ignore the tax treatment side of things. Which, again, that was you and me when we first got started.
Yep.
And I think
my reason for doing it was different than yours. I was just like, I don't understand that. I just want it to make money. Don't do all that fancy math or all the craziness. If it makes money without that, I'm good.
Yeah. Which is, that's fair. I get it. But as you get more sophisticated, and especially I think as you become a passive investor, it makes more sense to ask questions about, like, well, what's the after-tax yield on this thing? And what do those depreciation schedules look like? How are they doing it? Which, again, for Baker Tower, we're just doing this straight. I'm like, I'm not messing around with it 39 years, because I'm like, we're going to hold on to it for a while. Like, that's the plan. And so if I'm not going to sell it right away, I'm not going to spend money on a cost segregation just to speed something up that eventually we're going to have to pay back anyways.
Sure. So
questions you want to ask as an investor is, will there be a cost segregation? Will there be a cost seg? That's what the cool kids say. Cost seg. How are depreciation allocations determined? How do you handle refinances and 1031 opportunities? And then what's the timing of a K1 in historical accuracy of that? Because that's the actual tax report that you receive. So you just want to know, when am I going to get that? So when will I have to pay my taxes?
Interesting.
So so some of the advantages, like, they're pretty cool. They're not just loopholes. They're structurally built into this to incentivize people to invest. So I think they're really powerful tax savings.
Yeah.
I think there's more if you become an active person into it. So like, one of the things is, like, it's all considered passive income and passive losses. And so it can't directly offset your active income, which is fine, because if you're investing, that means you have passive income.
Okay.
But if you're doing it actively and a professional, then any losses can actually offset active income as well, which is convenient, but also a lot more work. So just invest with us.
You don't
Easy.
have to worry about that.
Don't worry about it. So so there you go. There's some Christmas cheer for you.
That was actually more interesting than I thought it was going to be.
Oh, that's what I like to hear. You're welcome. Making tax strategy interesting.
Everybody poo-poos taxes, but you don't have to be a Grinch about it.
Yeah,
There's some upside.
That's what you're saying. There's just two guarantees.
Death and taxes.
That's it, man. Dang. Yeah. So spoiler alert. So every year I've gotten into the habit of having a theme for the year that I listen to for audiobooks, and I do more like, Kindle reading stuff. But I'm pretty certain for next year what I'm going to do, because we're celebrating the U.S.'s 250th anniversary, is doing books from each quarter century. So like, my first one might be a biography on George Washington. The next one might be an interesting book on, say, the Prohibition that happened during the time. I don't know. Something I've always heard about, don't know much about. Could be interesting. And so just kind of working through time. So
you could read a book about the history of taxes.
Oh, I bet you that exists. For the right author, it could be really interesting.
Yes, if Malcolm Gladwell wrote that book, I would read it. If some tax accountant wrote it, I'd be like,
what about Adam Grant? You'd probably read it if it was him. You like his. He's the Rethinking podcast.
Yeah. He'd be interesting.
He's good. Anyways, I just listened to the podcast where he was interviewing a mentalist.
Ooh.
Oh, Oz Perlman.
Good one.
So good. Who also just recently wrote a book that is on my list. So I recommend it. Anyways, death and taxes, really interesting. If you got to do it, real estate's a great thing to look into to try to shield from some of those taxes in ways that, again, not loopholes, just it's structurally built in to be advantageous.
It won't give you eternal life, though. Only Jesus says that.
That's fair enough. Merry Christmas. Next week, we'll be there. Christmas Day. Look for it. It'll be fun. We're going to be talking about Hallmark movies. So it'll be super fun. So with that, thanks for listening. Have a great day.